Welcome to OK Bitcoin 69. Consider to subscribe and let's dive into today Bitcoin news.
My name is Brian DeLallo. I teach AP and Honors Economics in Pittsburgh, Pennsylvania. Financial well-being to me is knowing that I can be free to do the things that I love to do. I hope when I retire someday, they say, that guy made this place a special place to come to school and gave as much as he could to help the community.
All right, let's jump back to markets for our main story. Despite this week's gains, both Bitcoin and Ether are in the red for the month of July so far. To find out more on why, I spoke with Bill Barhydt of Abra, a global platform for digital asset prime services and wealth management. All right, Bill, thank you for being here. I want to start with just your reaction to where we are with prices. A lot of people we spoke to in crypto world have said that after the halving, investors should be prepared for a few lagging months before we see new highs. And Bitcoin is down 6.5% so far this month. Ether's down about 8%. Just walk me through how you're looking at the crypto market right now.
Sure. As it relates to Bitcoin and macro, I think there's three things that matter right now. The first is that coming into 2023, we really saw a bottoming in global liquidity. And it's really what happens at the margins that matters if you understand macro. And so that trough really led to a great year in 23. As liquidity increased, as there was growing excitement for potentially at the end of the year, the ETFs, and, just general excitement for what happens, in the halving cycle. So that all played out, right? And then coming into 23, coming into 24, I think we had kind of a temporary peak given interest rates in global liquidity.
The conversation appears to involve discussions around inflation and the Federal Reserve's approach to interest rates.
Was more
Here's a
successful
summary.
even than people had imagined. And people underestimated the tax implications
Inflation
for people
targeting.
withdrawing from Grayscale. And so
there is a question about whether the Federal Reserve will cut interest rates before reaching a 2% inflation target. The response indicates that the decision will not be solely based on hitting a specific inflation number, but rather on a comprehensive analysis of all available data.
This is still playing out because
data-driven decision-making.
Crypto,
the Federal Reserve looks at the totality of economic data, including inflation trends and labor market conditions. They aim to assess whether inflation is genuinely moving towards their target of 2% and consider the volatility in inflation data. 3. Maximum employment mandate. In addition to inflation, the Federal Reserve now also considers its mandate for maximum employment. This means they are evaluating both inflation and labor market indicators when making decisions on interest rates. 4. Confidence in inflation trajectory. The speaker expresses some confidence that inflation is on a downward trajectory. They likely see indications in the data that suggest inflation may be easing or stabilizing towards their target. Overall, the Federal Reserve's approach is flexible, with a focus on achieving both stable inflation and maximum employment, rather than rigidly adhering to specific numerical thresholds before adjusting interest rates.
And I don't think there's going to be more miners coming offline. And we're still under the mining price, meaning it costs 50K and change to mine a block, and they're earning more than that. So that's good news, right? So all of this purports to a really interesting second half of the year to me, where I expect to see risk on assets appreciate significantly, and Bitcoin has always been kind of a levered bet on risk on assets anyway, in terms of sucking up that liquidity.
Yeah, I'm curious about that conversation around interest rates in the macro environment. I mean, in recent days, we had the inflation data come out that lends credence to this idea that the Fed would start cutting rates later this year. But how much do you think that conversation still plays into crypto, if at all? Because, I mean, for so long, investors in the crypto space were watching the Fed, and then for a while, it felt like all eyes were off. You feel like that actually matters again?
It does, but at the end of the day, crypto has created too many couch potato macro analysts that don't really understand cycles in detail, right? So you got to look at the PMI, you got to look at interest rates, you got to look at global liquidity. What's China doing? What's Japan doing with their traditional yield curve control, activities? And when you play all of that out, we have to refinance, hundreds of billions of dollars worth of debt at much higher rates, and if we don't get those rates down via something like yield curve control or something else, we have a big structural problem. So all that basically points to the fact that we're going to have more liquidity in the system. We're going to have more money printing. And if we don't, it's going to be a disaster. And we're not willing to take the pain that it would take for that not to happen, which would be, massive cost cuts across the board in the West, and that's not going to happen. And unless there's something structural that breaks, we're in for significant either quantitative easing or whatever they're going to call it the next cycle.
I want to shift gears to something that happened earlier this month. Abra launched a treasury service at the beginning of July aimed at companies wanting to hold Bitcoin on their balance sheets. We talked a lot on Crypto World in the past about institutional adoption, but I want to hear from you about where we are on that front and how the companies you're speaking to feel about crypto right now.
Yeah, so it's really been an interesting cycle because we're seeing kind of post what's happened with MicroStrategy, a whole bunch of particularly mid-cap companies, even nonprofits come to us and say, hey, look, we saw your announcement about your new registered investment advisor, the separately managed accounts. Separately managed account basically in English means that you retain title to your assets. So all the shenanigans that happened with the Celsius, BlockFi's, Voyagers, whatever, can't happen because you're not on my balance sheet. And they love that model for holding crypto. And so they said, okay, I've seen the stock appreciation for MicroStrategy because they've effectively, put Bitcoin on their balance sheet, and that cash is always discounted to zero, right? Markets traditionally discount cash in your balance sheet to zero, right? Because it's a depreciating asset. But if you replace that with an appreciating asset, and what happens to be the apex predator, as Michael calls it, of appreciating assets, now all of a sudden they don't get discounted to zero. It gets a bump and a bonus for being on your balance sheet. And so we've seen several mid-cap public companies' stock get a huge bump overnight, 20, 30, 40% by replacing the cash with Bitcoin. That's point one. Point two is we've even seen nonprofits now, we have a couple in our system that have started to convert treasury into Bitcoin, and they intend to hold that forever if they can and actually borrow against the Bitcoin, right? So they can fund their operations by borrowing a depreciating asset against the value of an appreciating asset. And I foresee a lot of mid-caps, nonprofits doing this, and you're going to see significant increases in their stock value for those companies that have, 9, maybe low 10 figures of dollars in their treasury that's effectively being discounted either to zero or significantly, is now going to see a significant increase in its value because they're going to convert it to Bitcoin.
Bill Barhydt's interview provided insights into several key aspects of the current crypto market. 1. Market dynamics. Barhydt discussed the influence of global liquidity and macroeconomic conditions on Bitcoin's performance. He highlighted a recent trough in global liquidity and anticipated a rebound, suggesting potential for asset appreciation in the second half of the year. 2. Bitcoin halving impact. He explained the impact of Bitcoin halving cycles on miners, noting that the recent halving led to a temporary increase in hash rate and subsequent pullback. He suggested that hash rate may soon stabilize, which historically signals a positive post-halving phase for Bitcoin. 3. Macro factors. Barhydt emphasized the importance of understanding broader macroeconomic indicators such as interest rates and global liquidity trends. He suggested that these factors could drive liquidity into risk assets like Bitcoin. 4. Regulatory outlook. While not extensively covered in the summary, Barhydt touched on the regulatory environment and its potential influence on market sentiment and institutional adoption. 5. Institutional adoption. He discussed the growing interest among mid-cap companies and nonprofits in holding Bitcoin on their balance sheets, citing benefits such as enhancing asset value and leveraging Bitcoin for borrowing. Overall, Barhydt's outlook portrayed cautious optimism for Bitcoin's future performance, underpinned by macroeconomic conditions and institutional adoption trends. His analysis suggested potential for growth in the crypto market despite short-term volatility.